Gold has this problem of being a completely dead asset that can't be used for anything else other than for the price appreciation.
You've been talking about silver recently. There seems to be something a little interesting happening there.
Silver has recently started to make news because of a bunch of very interesting problems.
In a world right now where Indian stocks haven't been doing very well, would gold have been a good countervailing force to that?
If you invest for the next 10 years, equities are going to do better than gold. Only on 30% of the occasions, gold beaten the Nifty in terms of 10-year returns.
End of COVID phases, fine wines and watches had become asset classes. Why are these asset classes? We don't need them to be asset classes.
If you buy a really expensive watch, the second-hand market for watches of a certain type are so good that you might actually get more return on your watch. Gold prices are going up now also in the US partly because of fears of inflation going up. I think gold prices will correct. In 2011, they corrected 40% in dollar terms. America, which was the world's largest importer of crude, has now become the world's largest exporter of crude. Supply found itself when you raised prices high enough. That's the same with silver. Pakistan, one of the best stock exchanges. Not that any of us will ever
invest there.
Yeah, I mean, we just don't want the consequences of that.
To what extent should Bitcoin be part of your allocation?
The idea of a cryptographic thing is that
Deepak, unlike last time, I think everyone in India is now just break even or slightly negative over like a 12-month or 15-month period. There are very few people who are still managing to crush it in this environment. And even if there are one or two gifted or lucky or fortunate fund managers who have done so, I think anyone who's looking at their overall India allocation or their overall India portfolio, they're really kind of where they were a year ago or slightly less. So with that as the background, what are some alternatives that could do well? I think I was giving you these names before we started, right? These are what I could think of. Gold, Bitcoin, silver, foreign stocks, maybe put options, maybe just options in general. You've been talking about silver recently. There seems to be something a little interesting happening there. Can we start with that?
Yeah, we should. In fact, Shray, I think one of those problems in equities is we generally look at when equities are doing well, oh, is this sector doing well, is that sector doing well? But when you look at a completely new asset class like a commodity like silver and all that, it has a completely different set of rules of engagement in that sense. And silver has recently started to make news because of a bunch of very interesting problems. Now, commodities in general are either supply constrained or there's excessive demand, at some level. And that's what typically raises prices. Now, it means that if, for instance, half of the world's copper mines couldn't at some point operate, then even though copper is a commodity, copper prices will rise because demand being the same, supply coming down is going to raise the price of copper. Similar things will happen in a bunch of other places. Gold is supply constrained anyway, so largely the demand changes.
Always supply constrained.
Is always supply constrained. Interestingly, silver is not necessarily supply constrained. I'll come to why it's complicated, but silver has this complexity that sometimes rules that are very temporary in nature can affect it. Like, for instance, right now, apparently, and this is what I'm hearing from the grapevine, but India has a free trade agreement with Thailand. And apparently, because of that, a lot of jewelry that's imported from Thailand, because it comes in at 0% duty in India, otherwise everything else has a 10% or so duty, they are importing silver ornaments, which are basically, bare bones ornaments, mostly silver, which can easily be melted down and made into a brick in India and sold. As silver prices have been rising alongside of gold, people were using this channel as a mechanism for bringing in silver at a 0% duty, making up the markup. And the Indian government got wind of this, and then they said, they said,
you're bypassing our. This is not the intent of the law.
Come on, you can't do this. So they placed it on some kind of a selective import kind of a mechanism, and then because of that, the supply of silver in India has gotten a little constrained. That has raised prices in rupees somewhat. We are able to import from other sources, so we do import. And in this process, the price of silver have gone up. Now, people can buy silver directly, or people can silver ETFs have been introduced that they can buy silver using an ETF. Now,
in India, right?
In India. Yeah. Now, because of a physical silver shortage in India, because of the lack of this smuggling-ish kind of route, like I call it.
Loaded term,
yeah. Because of that, the demand for silver in India has been relatively high. So when you go to a shop and ask for physical silver, they're already going to charge you like a 5 or 10% premium, simply because there's a shortage of silver in India. So there's an international price, convert it to a rupee price, multiply that by a 10% premium, and then that's what you're paying. So people were thinking, listen, let me take advantage of this and buy an ETF instead, because prices are going up. I might as well take advantage. The ETF has complications because an ETF generally doesn't buy or sell silver directly. It exchanges its units for silver. So if I'm a market maker, I have to give them let's say a brick of silver, which is 31 kgs or 15 kgs or some number like that, and that has to go into a vault. Against those that bar of silver, I get units of the silver ETF. It's all perfectly fine. But what happens now is that when there's no bar of silver available anywhere, um, an ETF maker has to import the bar of silver from outside, and then it has to come in. It takes some time, and then units are issued. So there is a discrepancy between the time that I try to import the bar, because there's so much demand. Now the ETF maker also is like, listen, I'll buy this bar of silver only if I can sell the units in the spot market for a profit. There's a lot of demand for spot units on the ETF market. So people are putting buy orders. Now he's like, I don't have the units yet, so I'm not going to be able to place sell orders today, but I'll place it tomorrow because I've placed the import order for silver today. I'll get the units tomorrow. So during this one day, the price of that silver ETF disengages from the underlying NAV. Similar to if you go to a shop and say, give me the price for the price of silver, they say, well, it costs so much. No, but you know what? I'm going to charge a 10% premium on top of that also, because there's a shortage right now. So in the sense, the ETF market is charging a premium, sometimes as much as 20%. And that's what got people a lot excited a little bit on Twitter and all that. But this is a normal phenomenon. Now, when you have a temporary supply constraint like this, it gets bridged very fast. In a couple of days, the ETF is back trading to normal values, right? But silver prices have risen. They've risen to nearly $50 in the US market. But this is interesting because it's been 45 years now since the last time it hit $50. And the $50 when it hit the last time was when we talked about this in a previous podcast, the Hunt brothers.
Yeah.
The two brothers decided to corner the silver's market by buying, I think they bought 68% of the futures market in gold, in silver. They thought they'll corner all the silver in the world. Now, this is where I'm going to come back to my first argument, which is saying that are you really supply constrained? Because unlike gold, if silver is available relatively easily alongside other metals, people don't generally mine only for silver. There are some pure silver mines as well, but they generally get it as a product of if you're mining for zinc or copper. There are silver things available there, and therefore it forms part of your mining process, and it is also used industrially. So the demand is not only for investment, the demand is also industrial for many reasons, and it is also found relatively more easily in the world. It's not as precious in terms of being rare worldwide. So it's a great concept to have. Now you have silver as a thing, and the price is rising. What happened with the Hunt brothers was when they got the 68% of silver, you would assume that, listen, nobody can create more silver meaningfully. So if I have 68% of what is the market today, I have 68% of what is the market tomorrow. I mean, so technically I keep owning more and more of it. What if there were 100 tons in the market to begin with, and suddenly when you took the price to $50, it made sense for me to go down a mine and say, listen, let's mine some more. I might find some zinc, I might find some copper, but whatever silver I find is going to be sold at $50 a troy ounce, or $50 or whatever. And I would be able to recover so much out of that silver itself that it doesn't matter if the rest of my mining operation is not profitable. I'm actually earning the profits out of the silver alone. So instead of there being a market of 100 tons, the market increases to 150 tons. Now, your 68% of 100 tons is less than 50% of 150 tons. And then the market expands even more. You suddenly realize I no longer have cornered that market, and therefore I am just a too small a player. You have to give up your position because your leverage. That Hunt brothers went bankrupt because of this. They had borrowed so much money on leverage that they had taken to build this futures position, that when the prices fell, you just got disintegrated, and your selling brought the market price down by 70-75%. by on its own. So what went from $4 to $50 in 1980 and fell back to like single digits again, and it's only recently that it has come back. So it's taken 45 years, and perhaps gold to rise to $4,000, and there's a ratio between gold and silver that generally exists to bring it down. Can you bank on this happening for your long-term investment to happen? I think you'll get this phenomenon once in a while. So if silver has done its thing, it's found its short squeeze, if you may, but will it keep happening, and will silver prices go 10x in the next decade? I think unlikely, because at some point you'll hit the point at which supply increases again. Crude prices were at $120, $140 a barrel in 2008. Since then, America discovered a way to fracking to find oil. America, which was the world's largest importer of crude, has now become the world's largest exporter of crude. They had to change their laws, which didn't allow them to export in the first place. So, supply found itself when you raised prices high enough. I think that's the same with silver. If you raise prices high enough, you will find strange sources of silver all over the place.
That does actually fascinating as a concept, because these are at some level, as you're calling it, self-correcting. And so I take that point, and so they can't, silver at least in this case, will not just drift upwards endlessly by and large. But the fact is that, does it belong in your portfolio either as a hedge, a counterbalancing force, a diversification? Is it something that needs to be there? Because the fact remains that had you had a small allocation to silver over the last year, whether it's a temporary short squeeze, whether people are just like, everything can't be AI, so I need to have some silver, for some reason or the other, the silver price is going up, and it would have been helpful to you as an investor to have some exposure. Does this belong in your portfolio as a hedge slash diversifier in times when equities themselves aren't necessarily doing so well?
There are two ways to look at it. First one is, will it make you feel good as a hedge because you have a certain percentage of your portfolio in it? Now, for it to be meaningful, I suppose you would have to have 5 to 10% of your portfolio in it. But if you did, then you would feel miserable about it for the last 19 years. And the 20th year is when you kind of feel good about it, right? So you'd have to hold back your emotions for 19 years. While everything else is going up and silver is not meaningfully going up, even through whatever we saw in the COVID downturn, whatever we saw in the past, there were times in which silver spiked and came back. You might have felt good for those short periods of time, but it's great to have it as a part of your portfolio, perhaps naturally, because you may have silver that you actually use. So to a lot of people for whom the portfolio sizes are not huge, so you're talking about 1 crore to 5 crore kind of a person, they might
So like
actually
a
own 5
typical
lakhs.
PMS customer,
PMS
right?
customer. They might actually have 5-10 lakhs of silver just lying around. It's just, when I say 5-10 lakhs today, what is 5-10 lakhs is different from what it was 5 years ago. But assuming that you have 5-10 lakhs of silver just by ornaments, that is your normal natural hedge for this thing. But anything more than that, suddenly you're talking into territory where you're saying, I'm buying this as a financial instrument. It has no other use than to be a financial instrument. Then it has to match up with the returns that I get from everything else for most of the time, or be so small that it's irrelevant. Which comes to my second point. Maybe it's useful to handle the emotion of the financial hedge, which means you feel good about the fact that you have a hedge, but it's not so large that it is meaningful return. So for instance, if I have a 5 crore portfolio, I have, let's say, 10 lakh rupees of silver in an ETF. Now that's gone up 20%. I know that everything else is down
Or flat.
say 3 or flat. So I haven't made money on 98% of my portfolio, but 2% of my portfolio is up 20%. It feels good that I have something that's up 20%.
So this is, well, unfortunately or fortunately, very true. I think I have 2 or 3% of the money that I'm allowed to handle because I can't invest in India because of all capital mind rules is in gold. And it's up. And even though it obviously doesn't counter the rest or doesn't make up for anything else, it feels like you actually called this one right. But I get your point. So maybe it's about managing your emotional state rather than actually making
And
a profit.
I think that's a good thing. I mean, my personal feeling is that you should do, because it doesn't change your portfolio so much. Because if gold were to be a normal part of your portfolio for the last 12 years, you would have been maybe for the brief period that COVID was a little miserable. I mean, a little happy. But by and large, for the rest of it, it was a no brainer that equity was doing so much better.
I think just to summarize the silver conversation, silver can be an interesting asset, but the fact of the matter is that it seems to only be a token allocation, unless you're a market timer, which is a very different breed of individual. I think by and large, silver, if it deserves allocation in your portfolio, it's probably a token one, and the major benefits from it are, well, hopefully times like these when it's doing well, and then you can feel good about yourself. And then what? Would you take money off the table and use that to buy equities at lower value?
It's not a bad idea because you know as a market player that these constraints that cause silver prices to rise are temporary in nature. So you might harness those times and say, listen, I'm going to take that. So if it has to be 2% of my portfolio, it's gone to 4% of my portfolio. Then I'll bring it back to 2% by taking off 2% off the table and then go and put that money into equities in one way. So for instance, if you did diamonds, you would have a serious problem because it's structural. So the structural problem is that you can grow diamonds in the lab.
Yeah, correct.
And if you can grow diamonds in a lab, then your rarity of your thing is gone completely. And it's possible that affects your returns magnificently in the long term. So if you had diamond as a portfolio element, my suggestion there would be never have it.
Yeah.
But at least till now, people haven't been able to use alchemy to manufacture silver or gold. Interestingly, they've found something, and I'll come to it in the gold part of our conversation. But because it's so difficult to manufacture a base element, you have to literally add protons and neutrons into a nucleus of an atom, which is ridiculously painful and causes radioactivity as a side effect. But it's not easy to manufacture silver artificially. So supply is constrained to the extent that you can find it. And my contention to the world perhaps is this: there is a price at which everything will be found at abundant enough quantities if you raise the price enough. Whether it is
Oil.
crude or platinum or gold or whatever it is. So we should have that risk in mind. But with lab grown stuff, the risk is fair up and apparent. With silver, it's a lot lesser. With gold, it's even lesser, and so on. And I think silver is a useful part of your portfolio as long as you understand these constraints and that it's a very nicely time sensitive thing that makes you feel really good alongside.
So if you have silver, take the win is the thinking. Fine. Let's go to something that's a little more murky, if you ask me. Gold. Lots of gold bugs out there. I happen to have a token allocation which is doing extraordinarily well. In fact, the SGBs that I bought in India make me feel like a genius every time I look at them. But they are unfortunately small as an overall percentage of it. I guess everyone could, if they start adding their personal holdings of gold, the percentages may go up a tiny bit based on, I don't know, weddings or something. But the fact is, gold generally has been a smaller percentage of most people's portfolios. But unlike silver, gold is kind of supply constrained. And in that, maybe it belongs in much more serious sizes and in much more regularity and more consistency in your portfolio. And so in a world right now where Indian stocks haven't been doing very well, would gold have been a good countervailing force to that? But I would like to ask you another question. Abroad, where my foreign stocks happen to be doing bafflingly well, silver has also been going up with them. So I'm just wondering, when the inevitable correction does happen on these foreign names, will gold also fall, or will it continue to act as some sort of a hedge?
First of all, I must perhaps admit that I was wrong in that, I've never been a big fan of gold. I am still not a big fan of gold, but obviously at this point one has to say that, listen, gold isn't better than equities. So therefore, if my strategy was to never have gold because I don't think it's a good alternative to equities, I was wrong. And I think I will be wrong relatively often, but how often? So let's say that Deepak was on the side of saying, if you invest for the next 10 years, equities are going to do better than gold in general. So we took the Nifty TRI and said, okay, let's do a 10-year return. Now, Nifty TRI has only been around since 1999. So I have only 2009 to 2025 as 10-year batches. So we looked at that and look at monthly returns from then. I think between 2009 and 2014 or so, you had a reasonable growth in the price of gold in rupee terms. Part of it was because India raised the import duties on gold quite substantially in 2013. but also because gold hit $2,000 a troy ounce in 2011. So, you had that magnificent run. It's hit $4,000 a troy ounce today in 2025, which is 14 years to double.
Yeah.
Now, 14 years to double in dollar terms means a 7% return per year, maybe 7.5% return per year, which you will admit is not as much as Nifty's TRI return, which is about
I think
12%.
it's only 5%.
In dollar returns, yeah. So in rupee returns, it's possibly 5 plus 4.
Yeah,
so
so
9%.
Well,
That's close
yeah,
enough.
yeah,
It's close to Nifty returns. And I say right now because I think right now it has even beaten, it's at 12 or 13%. It's beaten the Nifty returns because you add the rupee depreciation, add I think there's still a 6% duty on gold where there used to be only a 2% or 3%. So there's an extra 3% that's come into the returns because of that. So you had gold returning 12% a year right now. But if you took the 10-year periods that were available for us from 2009 till now, only on 30% of the occasions has gold beaten the Nifty in terms of being better in terms of 10-year returns. That means 70% of the time, you are better off holding equities. You are better off right now having held gold for the last 10 to 11 years, but I would say it appears to me that it's a temporary phenomenon. Why do I say that? Is I think gold is largely a hedge for inflation and uncertainty. We have uncertainty today, but we don't have inflation.
Well, certainly in India, we managed to keep it under control quite a bit. The US people are a bit wary. They don't know which way the tariffs will intersect with the government deficit, will intersect with slowing economy. I mean, it's a complete question mark.
Yeah, and given the way the US is, which used to be the dollar was the asset that was a go-to asset for everything. If China is diversifying away from the dollar and Russia has been thrown out of the dollar economy in that sense, what happens now? Now, the biggest world miners of gold are Russia and China. So they actually make most of the gold, possible. So for them to increase their reserves of gold would not be such a big problem. And given that China is actually buying gold from other places as well, you actually have the ability to say that gold demand has been very high. Supply has been relatively low because these countries, although they make gold, they're not necessarily exporting so much of them. So to that extent, you have an interesting play in gold itself, where supply is constrained and possibly is going to remain constrained. And the demand for gold has increased because of the fears of whatever the US is doing with its internationalization, and with general retail demand coming in because they are watching this and saying, hey, I used to always like gold. Now I like it even more because it's going up. But this was not untrue of 2011 either. In 2011, they said when they announced QE2 or something. In QE2, they said, oh, there's going to be inflation now. They're printing so much money, there's going to be inflation. So gold prices went up with this fear of that inflation would go up. I think gold prices are going up now also in the US partly because of fears of inflation going up. But if that doesn't materialize, I think gold prices will correct. In 2011, they corrected 40% in dollar terms.
In 1 year or 2
in
years?
about 2 years, 2 or 3 years. And what was 2000 fell to $1,200. Maybe it took about 3 years for that. But you can't expect gold to have fallen 40%. In India, we didn't feel it as much because what happened was we introduced a 15% duty.
I remember that was the time when the rupee was weakening very dramatically despite this QE stuff. And at that time, we had to introduce these taxes, which then propped up the price, right?
Propped up the price of gold. Plus, we had the rupee to dollar conversion also getting affected because rupee went from, I think, 45 or 46 to 68. So there was a 50% drop in the rupee to dollar equation, or rise in the rupee to dollar equation, and or dollar to rupee equation, however you put it. But the interesting point about this was this resulted in India not feeling too much of this global price damage in the drop of gold. So we feel in India that prices can't fall too much, but prices can go up a lot. I think that would be the wrong conclusion to have because those circumstances were different. India had very high inflation at the time. It had between 9 and 11% inflation. Today, it has 2% to 3%.
This is when your mother locked in some 12% FD for 10 years, right?
Yeah. In 2013. It's come to a renewal right now and she's very unhappy that she's not getting that 12% return on an FD. But, interestingly, gold was not considered to be a bad asset even though it fell 40% in dollar terms, even though it, because once it falls, the idea is, listen, I like gold, I'm going to keep holding it. But when it goes up, they're going to look, I'm right, the gold has gone up. So there's no winning against a gold bug. And there's no winning against a person who feels that gold is always going to be a popular asset. But my feeling is you got to be a little careful that these situations, when they come through periods of uncertainty. We may not necessarily have these periods of uncertainty forever. Gold went up during COVID. We fixed ourselves immediately after COVID. Whatever is happening right now is man-made. The COVID was at least an external thing. To a certain extent, man-made issues can cause uncertainty for a longer time, because Russia, Ukraine, man-made issue, lasted 3 years. COVID externally impacted, all of humanity fought against it. It lasted maybe a year or less than a year. Because of the time frames of doing these things, you can have uncertainty periods for 1 or 2 years. But beyond that, they may not be that much. India has a lot of gold. A lot of our gold is locked in, whether it is in temples or something like that. We also don't allow the monetization of it. In the sense, if you buy a gold bar or a gold, any of these ETFs and all that stuff, that gold cannot be used to take a loan for doing anything else. So I literally have to sell it to get money.
But gold loan companies exist. They're enormous, right?
Against ornaments. So I cannot lend against raw bullion, which means that my buying the purest form of gold, which is the form of a brick or a coin, is not allowed. So to that extent, I would say gold has this problem of being a completely dead asset that can't be used for anything else other than for the price appreciation or as a bullion itself. As ornaments, as jewelry, it's great because there are two things. First, it makes you feel good, and second, it allows you to take a loan against them, both of which are good things to have, right? So I would say gold has its use in being useful as an ornamental wear thing. But to expect that this kind of a price rise will last forever, I would say no. But again, I've been wrong, and I am wrong at this point. So I have to admit that.
Look, anyone can be wrong. That's actually not the part that sounds fascinating to me. The one that I find interesting is almost a customer behavior or investor behavior thing. Let's say you're worth, I don't know, 5 crore rupees.
Yeah.
And then you buy a car worth 50 lakhs. You're now worth only 4.5 crores plus a 50 lakh car. But you think you're worth 4.5 crores. You recognize that the 50 lakhs is not really part of your net worth in that sense. You're not really going to sell this. And if you sell it, you won't get the 50 lakhs. You'll get something less, quite a bit less, I believe, the day you bought it or so on. So I understand that. But when I'm looking at my portfolio, if I'm going to put them all in equity, I'm this super demanding and difficult person saying this doesn't deserve to be in my portfolio. It's not doing well. I've lost faith in management. This sector is completely screwed. But if 5% of that money is say in gold and gold doesn't do well, I'm like, oh, this is fine. It's meant to be a hedge. It's almost like I treat it completely differently. So when it goes up, I said, see, I was right. And when it doesn't do well, I said, yeah, I know that because it'll do well at the other times. So how does one deal with this sort of like, is this a rational way of thinking about it? Is it just managing emotional expectations, or is it like insurance? It won't do well for many years and some years it'll do well.
It's a brilliant philosophical thought process difference. I think real assets have this advantage. If you buy land, you have a similar thing. Land has this advantage that people don't reevaluate, or even if they do reevaluate, they say we'll wait. People tell me that they want to wait for the metro in Bangalore before they sell their apartment. I'm like, that's at least 3-4 years away where I am. They're like, it's okay. I'm like, nobody will tell me. I will wait 3-4 years for Nifty to go back up. And it's very rare to find that, right? I have to try really hard to listen. It's not down too much. It's only been a year. So just hang on for a few more years and it'll be fine over the long term, right? You got to give any investment at least a few years before it gets. But it's so much easier to tell that about land or about gold than it is to tell them about stock A or a portfolio A or a mutual fund Y and so on. So I feel that maybe it is become a second part of nature for us. It says, well, if this mutual fund thing doesn't work out for me in a year, I'm done. But the land bit, I don't
That
mind.
is actually long term.
So gold is also.
We're able to bring in our long term thinking properly when it comes to, or the diversification thinking when it comes to say assets like land, real assets. We struggle when it comes to financial assets where the job is you're supposed to make me rich. What are you doing?
Yeah, almost like why haven't I rich already? Because I think people hear stories of people making a lot of money in land, but usually it's not overnight, right? The usual story is that you take land and you hold it for a really long time, and then it goes up 100x or 50x or whatever, and that's how you make a lot of money. But I remember this one story where a friend owned a piece of land, and there was this guy who said, listen, I will do a joint thing with you where I divide it up into plots, and I'm going to sell the plots. And I know it's worth, say, 20 crores right now. So why don't I do this? Why don't we share the plots half and half? And you will not only get your 20 crores, but you'll get whatever is above that in terms of number. I'll give you half the plots that I engineer. I'll give you some cash right now that gives you the ability to do this, and we'll do a joint agreement, do this. In that person invested possibly 8 to 9 crores, out of which he gave him 5, right? So this plots that were eventually sold yielded my friend a lot more than the 20 crores you would have got by selling that land. It was a very large piece of land, but assuming that, for the person who was coming in, he put in only 9 crores and got his 4x return or something like that over a period of less than a year. So imagine putting, I mean, of course, 9 crores is a lot of money, plus you need the contacts and the ability to pull this off. But assuming that you do, a 400% return over a year is nothing to scoff about.
No, I think I could live with that.
I mean, and this was over a period where possibly the Nifty probably did nothing because of the 2001, 2002 time frame. However, nobody expects the same thing of any land, even if I told you this story. It's not like if I told you this story, you'd go and buy a land and say, now it has to give me 4x in a year. You're almost like looking at this and saying, listen, that guy, he had lots of contacts and a lot of people to pull this off. Possibly great for him. That's not for me. I don't mind waiting 10 years. It's somehow not the same in when it comes to the stock market. But that's also why we give gold, I think, that much time. So there is so much of a defense of it because gold has lasted, I don't know,
Millennia.
400 years, 500 years as a known place to store stuff. And before that, it was actually currency. So to the extent that people were using gold as a medium of transaction, it was valuable per se. And now it's valuable as a place that you can store value in. Interestingly, people who are in the know, there are other stores of value like pens and watches and things like that, where if you buy a really expensive watch, the second hand market for watches of a certain type are so good that you might actually get more return on your watch.
But all of these require an element of judgment, discretion, knowing how to make these. I also remember reading in the Wall Street Journal about a website where people bought secondhand watches, and then I think either that company went bankrupt, the one doing this marketplace for secondhand watches, or all those watches just fell in value because I think just in the post-COVID or end of COVID phases, fine wines and watches had become asset classes.
Yes.
And then people later realized, oh, why are these asset classes? We don't need them to be asset classes.
And interestingly, could that not be the same as what's happening with gold and silver right now? Is that you're getting the fad approach right now where everybody's jumping in. What if people start to jump off? The supply constraint will remain, the demand will come down. At some point, the prices could correct meaningfully. I'm just saying this is the possibility that you should be aware of before you get in. Knowing that outside of the hedge times, insurance is the most expensive immediately after a tragedy. And perhaps the safest time to fly is after there's been a plane crash somewhere else in the world. Because now everybody's on high alert, right? So it's always the counterintuitive thing that makes a difference. So today, to buy gold as insurance is the most expensive thing because the baddest event of the times that you're expecting are happening right now. But when you're in normal times, then possibly makes sense to buy it as insurance against inflation and so on.
I would look, since I think I'll still be allowed for a few more years to trade in things like commodity, mutual funds, ETFs, and all that stuff. I think the way I would, however, approach it based on what you've told me so far is silver. I would still use a timing mechanism on it, and if I would hopefully be able to convince someone in downstairs on the third or fourth floor to help me out with creating an algorithm to just figure out whether it's in momentum or not, and then I would buy and follow a sort of like a timing model around that. Gold, on the other hand, I think I would, despite what you said and the fact, I think it almost deserves this small token allocation. If at the very least it could be a bit of a satisfier on the emotional front, and at the very best it manages to give me a bit of an insurance premium kind of situation when the rest of the stocks are doing badly, and then I could hopefully sell and redeploy that into equities at perhaps a lower valuation. I'd like to come to the next one. Bitcoin. Now, look, as you know, most people in India really struggle. It's difficult for us to buy Bitcoin, but I know there are enough legal and semi-legal ways or decent enough options where you can get exposure if you try hard enough. So let's leave that out of the question. Let's say you just had freely the option to buy a Bitcoin ETF or just buy Bitcoin in of itself. On Friday, I was hoping that as and when the stock market crash would happen in the US, things like Bitcoin and gold would go up. I think gold did go up, but Bitcoin managed to crash as much, in fact, even more than the US stocks. So that's not much of a very good hedge for me, right? And I think I've wiped out all the PNL that I've ever seen on that screen. So what's going on here? Are these cryptos and Bitcoins, they're like a modern day version of gold. They sort of have a bit of the same just faith and belief this is something worth having, but it kind of just behaves like another equity security.
I think it was built entirely to be a speculative security, though people will tell you otherwise and all that. But the idea of a cryptographic thing is that if I have a wallet and I have a blockchain, the blockchain is the effective arbiter of how much Bitcoin I have in that sense. So if there is a distributed copy of this blockchain and nobody can alter it because it's cryptographically signed and all that, because nobody can alter it, nobody can deny that I have a certain amount of Bitcoin, and there is only that much Bitcoin that has ever been mined, which is already part of the Bitcoin of the blockchain. So all the Bitcoin that has ever been mined is in the blockchain.
Or this upper limit where you know it'll never be beyond that point.
Beyond
like
that limit,
21
but
million
assume,
or
yeah,
something
21
like
million,
that.
and then you're incrementally adding only very little Bitcoin as the blockchain increases. So whatever is in the Bitcoin is the maximum of Bitcoin that has ever been mined right now, which means that there's no new supply coming. Yeah. There's no meaningfully new way to add this supply and alter any of this. So it sounds like something that should effectively have perennial demand. That means no matter what you do, if you have demand greater than the supply is very little, so therefore prices should go up in dollar terms or in rupee terms and so on. The problem is now that this has not just become a Bitcoin issue. It is now a leverage issue. It's complex because now there are Bitcoin would have been one thing, but there's Ethereum, there are altcoins of all sorts.
I haven't heard of those since 2021, but I guess I know they do exist.
Yeah, I mean, they're weird names,
22.
Doge and Sui and all sorts of things. So now you have all this stuff, but how do you buy it? So there's a Bitcoin in the world of crypto. There is something called a stable coin, which is one stable coin dollar against one actual US dollar. So you use $1 to buy one stable coin, and then that stable coin is a cryptocurrency. So you can trade it against. So there's a USDC and the USDT. The RBI also recently came out with a notification saying that it's trying to build a rupee stable coin guaranteed by the RBI that will reside effectively on the blockchain, but it's a rupee stable coin that can be used for transactions. I haven't seen this happen yet, but they talked about a process of doing so. Now this US stable coin thing is very interesting because now I can buy a Bitcoin for $1 and transact the whole thing in the blockchain itself, in whichever blockchain you're talking about. There's a Bitcoin blockchain, there's an Ethereum blockchain, and so on. So now, what if I told you that I could buy Bitcoin? I could wrap it into something and then say, I'm going to use this as a collateral to get USDT as a loan effectively, and use that USDT to buy altcoin. Right? Yeah, so I could buy one of these Doge. When the Doge goes up, I'm feeling very happy. I take the profits of that and use that Doge and stake it to go and buy something else. So staking means effectively I give it as collateral, and that something gives me some other coin in return. So I leverage it many times by going and getting into these multiple arrangements. And these altcoins fall 40-50% sometimes. So when they fall, there's an algorithm, because now we're techies, right? So everything's like an algorithm that says, well, listen, you took a loan, and the minute the value of whatever you bought falls below this value, I will sell the original coin that you staked. So I staked the Bitcoin to buy Ethereum. I staked the Ethereum to buy a Dogecoin. I staked the Dogecoin to buy something else. And all of them were rising. So I could do more and more. Now, eventually, whatever I bought in the end was a Sui or something that fell 90% one day. Then the algorithm looked at it and said, listen, your thing has fallen 90%, so I'm going to sell your Doge. The Doge falls in value. The Doge algorithm that looks at the Doge price says, oh, well, you have Ethereum, I'm going to sell the Ethereum now. So Ethereum falls. And then because Ethereum was staked against by Bitcoin or against Bitcoin, people end up selling that Bitcoin as well. So it's a leverage that causes this whole thing to fall overnight. This, of course, they linked it to the Trump announcement around Chinese tariffs and all that stuff, which is possibly true. I mean, that must have caused the consternation in the first place. But let's say there's somebody who's looking to dump a large amount of Bitcoin to generate cash or whatever it is. When they do it into a market that has primarily seen only upward demand, that means mostly there are more buyers than sellers. So the price keeps inching upwards. One day there's a large seller that's come in. There are not enough buyers to take the thing, and the markets are 24 hours. There's leverage. As if the price of Bitcoin falls 5%, then the leverage factor kicks in and makes the price fall 10%. So I think that is so you're into a market. Let's say all of India's gold. That's one of the reasons why gold is not allowed as a
Pledging asset.
because if you do that, you will buy physical gold, then you'll take a loan against it and buy more physical gold and pledge it and buy more. So you would end up, what would happen then is the price would go up like crazy, but it would also cause massive concentration in the market by bringing it down.
By the way, I was just reading some books over the weekend, funny ones. This Jim Cramer wrote a book on how to make money in any market, and there's a new Morgan Housel book out on spending money or something like that. Both of them, I think, end up talking about the Black Monday one in the US where the market falls 25%. So this echoed a bit of that, where there was all these like things set into like, if you fall 5%, then sell. And so the moment you actually breached the initial condition, then they all just kept reinforcing the other, and it just basically fell sideways.
Unstopped. It's called portfolio insurance.
Okay. But where I'm coming with this is the problem that I'm hearing is that you like Bitcoin. Most of us have sort of come to peace with Bitcoin, saying it does occupy a certain role in the universe today. We think it deserves to be a financial asset. So you would like to get exposure to it, but you have no say in, unfortunately, in the matter that people are using this relatively accepted and blessed asset like Bitcoin and using that to as leverage for other transactions. And so basically you can think you're playing in Bitcoin, but unfortunately you have a small exposure to these weird altcoins as well. Or perhaps put more differently, if altcoins fall, even your Bitcoin value will get affected, even though you have done this relatively sensible thing, and these are the people playing with fake coins out there. But in that sense, Bitcoin is always going to be plagued by the neighbors it has, or by its co-passengers in that what the other people have invested in. Whereas you can't get a Bitcoin that's divorced from the altcoin pricing reality. So,
yeah, I mean, it's interesting because Bitcoin is actually an interesting original blockchain concept, right? Everybody else has gone and changed that blockchain concept in a different way. Ethereum, for instance, has code that you can put as part of the blockchain. Ethereum's blockchain size is maybe 20 times the size of the Bitcoin blockchain, simply because of the nature of these things. And now it costs upwards of 1% sometimes to be able to get your transaction to be done. If you are using this as an actual currency, imagine paying 1% fees to get it done. I mean, in the world of UPI where we get everything done for free, we consider this a crazily high trick. America probably thinks 1% is too less because, you know what, you're paying 2% for a credit card anyway. But
that's a different story of regulatory capture.
Yes. So, but I'll come back to Bitcoin on this. It's a very interesting point. The risk is not only regulatory or things like that. It's like China has outlawed crypto a long time back.
Yeah.
It doesn't mean the Chinese people aren't doing crypto. They're doing it, but they're doing it in a difficult to understand way. The same thing would apply. I think regulatory risk would be there in India, where one day we might decide to finally ban everything. So you don't want to take too much kind of an exposure to it in general. However, the world tide is moving in a different way. They're trying to get into acceptance, mostly because Trump is kind of very pro crypto in that sense. Does Bitcoin have a place in a portfolio despite these risks? I think the only other risk is technology risk here, because things are moving so fast in the quantum computing world. Is it possible to break the cryptography that underlies what Bitcoin is? The answer has always been never in 1,000 years. But I think that word 1,000 seems to be coming down. So you're getting to a point where compute is reaching a point where a lot of these things are impacted big time. And the unfortunate problem in Bitcoin is the minute I change the encryption model to something that's more secure, I invalidate almost all the wallets that are out there in existence today. And Bitcoin is just too big to have um, invalidated every single Bitcoin wallet that is out there, because that was what it was supposed to be for forever safekeeping. So you're not allowed to, you can't tell me that my physical wallet today, which has a key which I don't even know about. I mean, they probably ask me for my password to unlock it, but the actual underlying private key may not even be available to me. That Bitcoin is no longer valid because it's not held in that device. That device just holds the access to my private key. The actual private key public key combination or public key of that private key is on the blockchain, and I have stored some Bitcoin in that particular address. I would require all such wallets to change their encryption format if I ever change the Bitcoin encryption algorithm. And that's what scares me sometimes, is that is it possible that we reach the level of technological risk where suddenly it can be broken, but I can't force everybody to change their algorithm?
Okay, so this one feels a bit out of my depth. You've mentioned this one in the past before, and I think you've got surprisingly far in the conversations, even with the purists who have had to concede some points on this to you. But let's hope that this won't matter.
I hope so. Yeah, I mean, I think I'm being an uncle, cynical uncle
cynical
here,
on this
but
one.
on this. But it's like saying somebody can manufacture gold. Yeah, they tried to manufacture gold. You know that they actually made radioactive. I mean, they did some putting neutrons into mercury. So there's a form of mercury called mercury 128 or something like that, which is, by the way, one neutron away or one proton away from being gold. Okay. So you take mercury and you bombard it with neutrons and protons, and then you can get something. And then if you get something that's radioactive gold, in approximately 17 years, it will fall to 10% of its value because it's radioactive and it gives out this thing, but it will form gold, stable gold. After 17 years, you will get stable gold. However, mercury 128, which is what is required to 198 or whatever it is so difficult to find that it's actually more valuable than gold itself right
Okay,
now.
so
I'm like, I'm going to buy something as valuable as gold, bombard it with neutrons, wait 17 years, and to get 10% of that value in gold itself.
It's not, just buy the gold. Okay.
Yeah.
Sure. Well, let's get to the Bitcoin and think of it again from an investor or a customer's point of view. Again, assume all the legal issues are not the problem. You're willing to say silver can be a timing thing and gold can be a small allocation or whatever size you're comfortable with permanently. To what extent should Bitcoin be part of your allocation as an investor? And one thing I've remembered over the last few years is it does fall horribly out of favor and crashes quite a bit, and then it does do very well. These cycles seem to take a couple of years, and I guess since it's a new asset, you can't really predict how long, whether these will become longer, shorter. That's not something you can really predict. But do you think something like Bitcoin just belongs in your portfolio? And would you follow the same discipline of if 2% becomes 4%, sell the extra 2, bring it back to the original 2% and use that to top up the rest of your portfolio?
I think in Bitcoin, that would be my standard, because I feel the technological risk category has a high thing. Regulatory risk also is high. So you have this problem of your assets being actually worth zero to you at some point in time, simply because the government doesn't like it or because the technology has changed. Let's say that was the risk. Then how would I play something like a Bitcoin? Would be to allocate a relatively small percentage of your allocation to it as a momentum play. And I think you should do this for gold, silver, and Bitcoin in that sense. Chase them when they're going up, because they can keep going up for a long time. When they're going up and you make a reasonable amount of profit, book it so that you can recover most of what your initial investment is and have less emotional baggage riding on that investment. So, for instance, if your 2% became 4%, you took out the 2. In your mind, you're like, I've recovered the money that I put in here. Although, I mean, philosophically, you should never think of it like that. But I would say you're almost only investing your profits. This gives you emotional satisfaction that even if you lost all or most of it, you would still think of it as only profits. So therefore, you would be like, I almost got this for free. Then guess what? It's gone, or most of it is gone. It's still okay. So it gives you that emotional satisfaction that you're not riding that roller coaster with money you can't afford to lose because you've taken out the money that you put into it in the first place. Bitcoin, I think, belongs there. Silver, I don't think it'll ever go to zero, neither will gold. So there will always be some value for it. So I think as long as you don't over leverage yourself, or even in fact leverage yourself, having allocations to each of them, gold more than silver. And much as I say this, I should admit that we are going to hopefully launch a multi-asset fund and all that. So we know that, I mean, at some level, I know that this is me talking business and shop as well. But I also think it's a useful thing to have from a perspective of a person looking at this market and saying, why am I missing out on this? You should participate in any market that makes you money because in the end, the color of money is the same regardless of where you go.
On your point on taking out your initial principal and just gambling or continuing to be investor or at risk with your profits, I just found personally that it works when the profits are, say, reasonable. So for instance, in a relatives account, there's a 50K of Nvidia that has become 500K. I could just take out the 50K and say, look, we're all is good. But obviously, it doesn't have the same impact over there. I think if you do end up making something like 10x, you can't just take out 1x and say this 9x is all value at risk. You do want to perhaps take something more off the table, I found.
I agree with that. In fact, it's great to just bring it down to a portion where it is, for instance, it was a 500K of a $2 million portfolio. Thinking, even if I took out my initial capital, I'm still with 25 or 22 or 23% risk on my overall capital. And I know people who are like that who worked for, say, an Nvidia. For them, it's like 80% of their portfolio simply because they've never sold it. Now, there would always have been a point in the past where I would have said the same thing. Don't have 80% of your money in one company. It may have worked out with Nvidia, but I can tell you a lot of people from IBM who probably thought the same thing in the 80s. That hasn't really worked out. So I think just having that diversification is good. So if you are working in a company and you have some visibility into its future, even having a 35-40% allocation is fine. But if you don't, and you don't really have a visibility into the future beyond what most of us have, then maybe 10 to 15% is the maximum you should have in an asset.
Point is taken. So we've covered silver, we've covered gold, we've covered Bitcoin, and I think that's as far as we'll get in the crypto universe. Foreign stocks. They've actually done very well for, I think, not just me, but anyone who I've spoken to. I know China went through a horror run for like many years, I believe, and people said it was uninvestable, but now they've had a bit of a resurgence, so they're coming back. Japan is doing really well. I just followed Warren Buffett's entry into it, and it seems that that was good enough. Foreign stocks could potentially be a proper hedge or a proper diversification to your home country allocation. Unambiguous good having some foreign stocks.
One of the reasons why we like Japanese stocks, for instance, is that in rupee terms, they've done relatively well. I think in dollar terms, they're not done as well because the dollar went from 110.
It's almost 160 now, I think.
160. So
almost.
So to that extent, it's gone now. It's got a 50% depreciation in the value. That means that its return has to offset that 50% depreciation for it to be. So it depends on where you are. China also interesting from a point of having done a 40% year. Pakistan, one of the best stock exchanges. Not that any of us will ever
invest there.
Yeah, I mean, we just don't want the consequences of that. But the issues are that correspond here are also similar in that sense that can there be a black swanish kind of an event that wipes out most of your money that you made in investing in some of these things? I think the answer to that is relatively no. You need the whole world to collapse, and if it does, then what are the chances your home market won't collapse also? So having a 10, 20, 25% allocation to someone abroad, so markets abroad, global stocks would be not a bad idea at all. And whether it is developed countries like the US, frontier markets like Africa, places like China, which traditionally it sound like very difficult markets to invest in, but are technologically making leaps over everybody else. Japan, where after 40 years you suddenly have inflation, which is allowing people to potentially raise prices, which is considered such a bad thing. So each of these markets has an attraction by itself, which does not have any similarity in India. India is just one of those, we are growing and we value a lot of metals and we value pharma and we value IT, but not technology or AI or 3D printing or EVs and all that stuff. We don't value it as quite as much in terms of technology building. So we will take the Indian market for a certain home country bias and so on. But the global markets, and I think we've talked about so many times since 2017, we've been talking about having some allocation outside of India. But the idea of having an allocation outside India is simply that you diversify away. But can you forever feel that, let's say, today I would say if you had 50% of your money outside, it would probably, because you had about 30% of your money outside, you added some more money and you took it to 50%. So maybe you can change the incremental flow such that you're not so dependent on the foreign economies. And again, here you have another layer of regulatory risk that if it becomes certain size, you have issues, or that if you're investing in the US market and your
Inheritance
portfolio is
tax.
yeah, so the 40% inheritance tax applies. So you have to remake your vehicles, kind of different. You also have the complexity that China has never liked non-domestic investors even in their own stocks.
Yeah.
So it's possible that they find a way to say, listen, the stock has gone up, but you're never going to realize any profit out of it. So those are these layered risks that you have. So you want to keep them under control. So if you made a 40-45% return, you want to reduce that allocation to that much to counter any of these complex risks and go longer term into maybe markets that you trust. But I would say having that allocation is always a good thing, and never bring it down to zero. But at the same time, recognize that there are these external risks. Yeah.
I have just a point to make there, which is that I think unlike say things like gold, silver, and Bitcoin, which we're talking here, if they maybe even I would say I would apply this personally to gold as well. If these just do very well and become a slightly bigger percentage, I may not be as inclined to sell them. I would hopefully just keep adding money. I'm still in income generating stream. I would just maybe not add new money there as much, perhaps. So not very momentum like, but I guess I make the point. I'll come to the last thing that's come to mind. We've hired recently a fixed income person. They'll be launching, I think, a liquid fund or something. I mean, sorry, I'm sure the announcements will happen when they have to happen, but they'll be launching some debt mutual fund kind of products in the near future. So the question that comes to me is, for the last many years, I've always viewed debt almost as this, given my baggage where I lived in the US where the rates were minuscule. I mean, we're talking not even worth the interest you would get post tax, barely anything. Debt has never played a massive role in my life as an investor, especially in India for the last years. We had a nice credit cycle where if you were well positioned, I think your debt mutual funds could have gone up 10-20% in like a 18-month period. So that was obviously a win. But by and large, this has just been a parking mechanism to facilitate STPs. Just make sure you don't lose out on inflation while you're keeping your money on the sidelines. It's like a supporting act to equities. But isn't this just because equities have done so incredibly well in India? And there could be longer phases when debt actually comes and saves you, and it's not just a parking mechanism on the side while you figure out what's going on with equities.
I think there are two speculative elements in debt. One is a bet on interest rates falling, and another is a distress situation. Now, Howard Marks, very famous. People quote his thoughts on as if as part of investing in equity markets for the longest time. But he's a distressed debt investor. He makes equity level returns by simply buying debt at a value that is ridiculously low, and then profiting on it when those companies recover, because he has the confidence that the company will recover or the underlying asset is reasonably valued. So to give you an example, sometimes in India it's not very common because institutions in general are not allowed to buy debt at distress level situations, and the regulator themselves has been unkind to people who have tried to profit from distressed situations. I'll give you an example. Kingfisher Airlines had a bunch of debt. Apparently, they had taken some debt from this company called SREI. SREI is no longer in existence, but to give you an idea of what had happened, SREI Finance, or at least one that particular entity. So there was a loan given by ICICI Bank and another loan given by SREI or something like that, or against bonds. These bonds had the collateral underlying of some shares of the Kingfisher group at the time, which had some UB and all that stuff. So now Kingfisher's defaulted. As a borrower, if I default and I've given you a collateral, it is completely under your right to take that collateral and cash it for whatever it is, right? That's the concept of collateral. If you default, I'm going to sell it. So SRA took this collateral of shares and sold them. And they made a killing. They made 500 crores or something like that. And this guy said, listen, you only owe me 300 crores. So guess what? I'll put the remaining 200 crores into an escrow account for anybody else who has claims against them to buy.
Very nice of them.
They even went to RBI and said this.
Okay, but looks like it did so well.
Did not like this. How dare you take your 300 crores out before everybody else?
Okay.
Well, he said, well, they defaulted. I had the collateral. I just took it. That's my point, right? That's the point of collateral. No, this, and there was no Bankruptcy Act, or there was at that time there was no Bankruptcy Act. So instead of asking ICICI Bank, why the hell didn't you then sell the collateral and recover your money? They said, no, take this entire 500 crores, put it together. We will figure out how to distribute it later. This is terrible credit practice. And this was done by the RBI knowingly. And since then, of course, the RBI's thought process has changed to the point where they will say, listen, it's completely on you to take this. I think it's perfectly, valid to say as a debt investor that if you're not going to give me the upside of something that, or rather protect my downside, allow me to protect my downside, why should I bother investing in such a market? If, for instance, if there was debt available at 20 rupees for every 100, 20 cents to a dollar, or, there are times in which I might actually buy that debt because I think this asset will recover 40 cents. So I'll get 100% return. But if the answer to this would be that the regulator will look at me and says, how dare you earn 100% return? Then I'm like, listen, I don't even want to participate in this business. So let the 20 go to zero. I won't even buy that debt. I won't allow the company to be resuscitated in any meaningful way. So I think that is a little unfair. So we're in that early stage of that. But I think the opportunities in India come from inefficiencies. The debt market operates differently between different people. I could have two trades of the same underlying debt instrument. One at a 7.5% yield, one at a 7.8% yield. Now this sounds like quite a difference for this thing. But then why is that? Because the market has a lot of asymmetric knowledge. One guy might be selling at 7.5% because he knows the market very well. Another guy might be buying for 7.8% because he doesn't know the market, or rather, because he knows the market too well, even better. And the person who's selling at the 7.8% yield is selling at a lower price, higher the yield, lower the price, at a lower price than the 7.5, but he doesn't even know that the 7.5 is happening at the same time. It's a asymmetric knowledge by definition. So you tend to make knowledge in India by this asymmetric knowledge. This is a nice way to say there's a lot of insider information in this market, but unfortunately, debt has
a different set of rules.
Yes. For instance, all bankers can buy stocks of the companies that the bank lends to.
They can't buy stocks.
They can.
Oh, they can.
For the most part. No banker is told, no, you cannot buy these shares. Even though they have access to the individual bank accounts in which the company makes its money. So, whereas we, who basically buy shares of other companies, aren't allowed to buy shares in our personal names because our very business is to buy shares of other companies.
So the thinking is you'll front run or have insider information.
Yeah. But there is much more insider information in the banks, and guess what? There is no regulation that stops.
Well, I think banks themselves just generally make their lives. Don't let anyone trade if you work at a bank. So,
yeah, I think it's that at a senior level, yes. But I'm talking about junior levels.
Fair.
There is So at senior levels, I'm sure they have enough. No, but I mean in general, of course, there is a rule that says, well, you shouldn't trade on insider information. But it's a lot more lax at the banking level than there is.
And I think perhaps the point I'm taking away from here is that debt, at least in India, has asymmetries of information. There is money to be made, which brings me to then back to my question as an investor or a customer. Okay? So this one feels it's a bit more inefficient. So should I be investing here? And not just as a parking function while equity corrects?
Yes, I think it's a great combinational mechanism with equity to reduce what is called the overall volatility in your portfolio. So the way I see it is, I invested for my son for his college. So there was a investment in a bunch of equity investments. But as he gets closer and closer to college, I don't want all of that money to sit in equity investments. I want a certain percentage to sit in something that is relatively more stable, and it won't go down too much. So a couple of years of fees, I move into debt funds.
So that in case COVID like situations happen, you won't be like, oops, I can pay for now one less year of
Yes,
college.
I mean, I can't do that, right? So at some point, his third and fourth year's fees, I might still say, okay, I can risk it in the equity market. But the first and second year fees, I want to keep in relatively safe avenue. So that way, I kind of balance it out. The second part of this is sometimes there are great returns to be made in equity, in debt. We saw this about 2 years ago, where we switched 2023, end of 2023 is when we switched portfolios in the PMS to longer term gilt funds. Now, in a year, the longer term gilt fund portfolio would have made you about a 10 to 15% return in a year or so. Now, 10 to 15% is great in debt markets, but of course, equities had given 40% that year, so nobody was too happy about a 10 or 15% return. But it's still like once in 2 or 3 years, you're going to find this 10-15% opportunity, which is good enough for you to kind of have as a portfolio base. But even if in general you are just keeping money in something that has fixed income, I think it's very useful from a feeling of satisfaction. I'll give you some big examples of where. Let's say you are a company. You don't want to risk your money in equity, but you do want some better return than a current account which gives you 0% return. The answer is you could put it into a fixed deposit in the bank. And as we are finding out, if you put your fixed deposit in a bank at say 7.5%, that's what we've got from one of the banks. But they told us, listen, whatever you spend, you can spend from this fixed deposit, do whatever. But when we calculate the return of the money we've taken out to spend, so we've taken out, let's say, 50 lakh rupees to spend for something, then I say, listen, that 50 lakh rupees, they charged me a penalty and something else, something. What? How much money did I earn on this 50 lakh rupees? The answer was 3.5%. So for the period, even though I had been invested for 10 months, I took it out on the 10th month. There was a 12-month fixed deposit. They gave me only a 3.5% effective return for the time that I was invested. This sounds like cheating. I mean, somehow in my mind, it was like...
No, actually, somehow I'm at peace with this.
Yes.
I get, but I do very much take your point. So mutual funds serve a very different purpose, and debt mutual funds deserve to be in your portfolio for this.
Keeping it from a perspective of saying I will earn some return and I will get to keep that return without this crazy penalties when I need it, especially for money that I think is relatively liquid. The part that I think people don't get intuitively is how do you look at your portfolio overall? So if you take a person who has 5 lakhs in equity and 95 lakhs in a FD,
Okay.
and the equity markets fall 10%, he's going to be miserable that he lost 50,000 rupees. Whereas, the overall portfolio is down only 0.5%. So he's not going to look at the overall this overall portfolio piece. If we are somehow able to abstract and show people, I think that will increase their ability to invest in debt, because you'll be like, listen, it's okay. It provides the necessary, stable fulcrum to the portfolio. A fulcrum in a setup in physics doesn't actually move, but if it doesn't exist, you can't move the thing that's on the extreme side.
So someone needs to build the great unified app where you can log in and see your net worth by asset class, even though it includes some things from banks, some things in mutual funds, some things in demat accounts, so on and so forth, and maybe even some land and other assets.
Yes, I think, I mean, at least your risk, at least your market portfolio should be valued as a combinational equity plus debt framework rather than
just in isolation. I take up. So Deepak, I think I'll end with this. Right now, I mean, it's been 12 to 14 months of very ordinary returns in India. But I remember, I think it was just Aswath Damodaran recently just said that, even after this, India is not far from cheap. Does that worry you that despite all this, India is therefore still expensive? And so this is not it's been 15 months, and my gold and Bitcoin and silver have done well. So let's just sell those 2% and just plow into equities. Is that not necessarily how you think?
That's a good question. And India is not cheaper than it used to be. So it's about 21 times or 22 times earnings in the Nifty, possibly more on the mid caps and small caps. But is it useful to just look at this in isolation without the growth? I'll give you one simple example. at 4% inflation, which is what we have today, maybe less than that. We have about
That's quite
3%.
remarkable, right? I mean,
It's amazing.
kudos to the government or just macroeconomic forces?
It is. I mean, today I commented on Twitter that somebody was saying that the tickets to Diwali have gone to 19,000 rupees per air ticket. I'm like looking and saying, I was in 1997 or 1998. I started my business. I remember I had to go to Delhi once and I paid 12,000 rupees one way for a Delhi ticket from Bangalore. That was ridiculous, and I know that was crazy because 12,000 was most of my salary at the time.
Well, hopefully the business could pay for it.
The business paid for it. I mean, what it was paying me as a salary is it's a significant amount of that. Whereas 19,000 today, even considering inflation and all that, it's like much lower than what we would pay even an entry level person today. So it's like somehow the 19,000 rupees sounds like it's a lot lesser. We should have been seeing tickets at 45,000 rupees, just looking at inflation. But we haven't seen
because
that.
of supply increases, I would imagine.
I think
among
supply
other things.
increases. I think efficiencies in the ecosystem, better engines, more routes, more planes, so on. So I think one is that.
Okay.
So inflation is low means that the purchasing power of a 100 rupee investment today over say a 10-year period at 4% inflation would be maybe 160. I'm saying
Will it
it's
go up
not
that much? 150 maybe? Or-
yeah,
okay.
160 because of compounding effects.
Oh, okay. Fair.
Let's say 160. So that means what is worth 100 today will become 160 if you got an investment that just about countered inflation.
Sure.
Which is most fixed deposits and so on. So you would say, okay, 100 becomes 160 rupees in this time frame. However, the Indian economy seems to be growing at around 10%, 12%. You might get a company that's growing 14 or 15%. At 14%, it doubles every 5 years in terms of profits. So let us say you had 100 crores today. It would become 160 crores in 10 years if you put it in an inflation equating asset. But if you took that 100 crores and put it into equity, you're saying the market is expensive at 20 times earnings. And I'll say, listen, 20 times earnings means they're earning 5 crores, you're paying 100 crores for them, right? That 5 crores is going to grow to how much? Let's say 14% a year. It will double to 10 crores in 5 years and 20 crores in 10 years.
So doubles twice. Yeah.
Doubles twice. So it will become 20 crore company in 10 years.
Yeah.
Let's say at that time, you're unwilling to pay India this 20 times premium, but you're willing to pay only a 10 times premium. That means for 20 crores of profits, you will pay the company 200 crores. That means your 100 crores today has become 200 crores in 10 years simply by growth and by a derating of PE by half.
Despite that, what you're trying to say is even in this very extreme example, you're still
better off than the inflation. And it's because inflation is low. If inflation was 10%, I would never have made this argument. Okay. Inflation is 4%, growth is 14 or 15%. That is why I think it makes so much more sense even to pay 20 times earnings sometimes on companies that grow. So if by that metric, we are able to grow to meet this 20 times earnings, then I think we should be fine longer term. What my problem is that we haven't actually seen this growth percolate into our top level companies. This 14% growth I talk about should have been there. Unfortunately, they've grown only at 10 to 12%. So the economics becomes more unstable when growth is lower. But I would say at a 10 to 12% growth, I would still justify these kind of multiples at 4% inflation. I wouldn't justify it if inflation were to rise or if growth were to fall. I think, however, India has a meaningfully high growth rate ahead of it. So you're not getting things cheap, but you're getting things cheaper than if you invested in an inflation protected product. So as a home country biased person, I would say my better bet is domestic growth, simply because the growth to inflation differential is so much higher. Whereas in the US, if I talk about a 6% growth, I'm talking about also 3.5 to 4% inflation, where the effective growth path is much lesser and I'm paying much more for that market.
Well, encouraging words, Deepak. So let's see where we end up a year from today. Whether Indian equity markets actually continue to sort of like just go sideways for a bit amidst all this uncertainty, and where these alternatives land, and whether new ones
We should
emerge.
do this,
Let's
is
see.
our alts worth it next year?
Yeah. We'll see what happens. Yeah. Thanks, Deepak.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully. Past performance may or may not be sustained in future and is not a guarantee of any future returns.